Guaranteed investment certificates, or GICs, are low-risk investments for income investors looking for a steady stream of payments. You can think of them like a loan. The investor lends money to an entity, typically a trust company or a bank, for a set period of time in exchange for steady interest payments. And depending on the GIC, a number of payment options may be available, including monthly, quarterly, semi-annually, and annually. Short-term GICs offer terms anywhere from a month to 364 days, while long-term GICs offer terms of up to 10 years. Here's an example of how it works. Let's say you buy a 1-year GIC for $1,000. It has a 4% interest rate and makes payments on a quarterly basis. That means every 3 months you get $10 for a total of $40 at the end of the year, plus your initial investment. Keep in mind that if you decide to cash in your GIC before maturity, you risk foregoing any interest you stand to earn. And non-redeemable GICs typically have an additional penalty for cashing in early. Nevertheless, investors like GICs because they offer steady, predictable returns and virtually no risk to capital. That's because GICs are covered by the Canada Deposit Insurance Corporation, or CDIC, up to at least $100,000 per institution, and potentially more depending on the account you invest from. That means that even if the entity you're loaning money to defaults on their payments, you'd still get your money back. This makes GICs a safer investment than some other fixed income products like bonds, which often come with higher default risk and no default coverage. To find out how much your investments would be covered for, head over to cdic.ca/calculator. As with all investments, there is some risk associated with GICs, namely inflation and interest rate risk. Inflation is the rate at which the price of goods and services rises over time. It erodes the purchasing power of money, meaning you won't be able to buy as much in the future with money you earn today. When the GIC maturity date rolls around, the value of your return may no longer be the same, and that risk increases the further away the maturity date is. GIC rates also fluctuate along with interest rates. Say you're holding on to a long-term GIC when interest rates hike. Your money is still tied up while other more profitable GICs are becoming available on the market. Spreading your money across different maturity dates may help reduce your portfolio sensitivity to changing inflation and interest rate environments. To do this, fixed income investors sometimes use a strategy called laddering. It works like this. Say you have $10,000 to invest. You spread the money equally between 5 different GICs with different maturity dates. The first one matures in a year, the second in 2 years, the third in 3, and so on. When your 1-year GIC matures, you reinvest your earnings into a second 5-year GIC to keep your ladder going. Laddering may help you maximize your potential returns and is a way to avoid tying up all your money in one investment. To see an overview of available GICs in WebBroker, head over to the Buy Sell Quick Launch icon on the top right of the screen, then the GIC tab. And watch how to buy a GIC for a walkthrough of the buying process. Have more questions? Check out the links to the right and in the description below.